Welcome everyone, part 4 on our series on discretionary trusts. Now, last video we went through a basic example of how tax works with trusts and how it flows through the trust to the beneficiaries. And we went through a basic example of comparing a few scenarios and saying, all right, the trust does save us some tax in this case. So, quick disclaimer again before we follow on, please go get tax, legal and credit advice. If you're going to implement any of this stuff, come talk to us, we can help with the tax and accounting side of things. Now in this video, I wanted to go through a little model that I have built and used with a few clients in the past. And this is a model that's designed to basically help us decide whether or not it's worth setting up a trust, see the benefits and the costs over a 10-year time horizon, and look at if we're actually saving any tax, or maybe we don't quite have enough funds to invest to make it worthwhile yet. Okay, so let's go through this, and this will be a bit of a instruction video on how to use this model, so that if I send you a copy, you'll be aware of how to use it, and also just demonstrate that there is considerable tax savings to be had in certain cases. So let's go through it. This top section here is where we put in our inputs to the model. Remember, blue text is our inputs. That's what we're going to manually type in, and the black text we leave. We don't touch that. That is the model or the spreadsheet automatically calculating everything. Okay. The idea here is that we're going to put in different types of income. And a few assumptions of that, what that income will be over the future years, and then that will drive the model below. Okay, so we don't really need to touch any of this. We're just working in this top section here. So in this example, when I set this up for a client, they already owned 2 rental properties, and we're going to say, this is John and Jane. Okay, so this is a husband and wife couple, and they already had 2 rental properties. Okay, so we had, all right, what's the weekly rent? So we're going to type those figures in. What that gives us our annual rent minus our annual costs. So that's rates, insurance, property manager fees, repairs and maintenance, strata fees, all those sort of costs on the property. That's going to give us our net rental income for the year. And then our share, so they owned these properties in joint names 50-50, so that gets split between the 2 of them and forms part of their taxable income in their tax return, and ultimately that figure is what we pay tax on. Okay, now what else, or what other income do they have? Here, this was really the question that this model was asking. They were receiving a gift or inheritance of $1.5 million, so quite a decent amount. And they were going to invest that gift into shares, on the stock exchange, so earning dividends and other investment income. Okay. So here we had some assumptions. We said the dividend yield, the cash yield on that investment was 4.5%. And we're going to get some franking credits as well. I won't go into franking credits in this video, but I'll go into that later. And so that would give a total, so based on this $1.5 million portfolio, paying 4.5% yield with some franking credits, that would give us taxable income of $90,000 per year that we're either going to be taxed on in our individual names, or that's going to flow through the trust. Okay, so that is the question that we're asking, which is better. Another scenario where you might use a model like this is if we're running our business through a company and we've set up the trust to be the shareholder of that company. And I think I mentioned that in a previous video. That's a fairly common setup. And so, for example, if you were going to do that with this model, you might say the business had a good year and you were going to pay out a dividend of, get my zeros right, of $100,000, okay? Now, again, with the franking credits, that means we have $133,000 worth of taxable income that we need to deal with through the trust. Okay, so let's just zero that out and stick with the original scenario where we've received a lump sum of inheritance and we're going to invest it. The other input we want to put in is a salary. Okay, so a salary or wage that we're earning, and in this case we've got John earning $135,000, and we've got Jane, let's just say she's currently at home with the kids, and then we will fiddle with that later to see how it changes the answer. Once we've got those inputs set up, let's look at our 10-year forecast, okay? Now, scenario 1, which is right here, this is saying, all right, we do nothing. We don't set up the trust, and John was the one who inherited the funds, and he wants to keep them in his own name, and he's going to invest them all personally himself, and so therefore he is personally going to be lumped with the taxable income and the tax on those investments. So how do we read this? We're going across the years here. That's simple. And then we've got John and Jane, and we're looking at these lines here. We're looking at our taxable income. And so you can see John's taxable income, 246. That is a sum of his wage, his share of the rent, and his dividends, okay? Or the dividends on the portfolio. Jane, in this case, she's just getting her share of rent. She doesn't earn a wage in this case, and that is, and she's not receiving any dividends because in this scenario, John owns them all. And you can see here, total income as a couple is $267,000 per year. Now, tax on that, you can see here, John is paying all the tax. He's paying about $81,000, and Jane is really just over that tax-free threshold. And in reality, she probably wouldn't pay any tax at that income level. But I will just note this model doesn't account for things like the low income tax offset or Medicare levy surcharge or Division 293 tax, for example. Won't go into that right now, but these figures are very accurate except for a few offsets that you would get when your income's very low. So in this case, Jane would actually have zero tax, but let's go with the model. Total tax is about $82,000. And we're trying to compare that against, okay, what would happen if we actually use the trust? And I've said here, implement trust structure to equalize income. And what that means is we're trying to get John and Jane's income to be as closely matched as possible so that they're both using up their lower tax brackets before they start getting taxed at that higher rate. Now, you can see here, John's income using the trust is much lower and Jane's is much higher, but combined as a couple, they're still earning the same amount of income. And the trust isn't changing how much we make, it's just changing the portion that goes to Jane versus John. Okay, and you can see there the tax figure there. John is paying about half as much tax as he was in the first scenario, and Jane is paying more tax. She's paying 26 grand instead of virtually none. But overall, the combined figure really is what we're looking at here. And so you can see under scenario 1, 82 grand worth of tax. Using the trust, we've got about $68,000 worth of tax. So in this scenario, we're saying the net benefit is $13,000 per annum, minus the costs of running the trust, so accounting fees, maybe some bank fees. That's an estimate, might be more, might be less. So we're saying a net benefit after costs per year is about $12,000 from using the trust structure. Over the 10-year time horizon, that would be $120,000 better off using the trust. So you can see here the results do compound over the years. And the thing that this model doesn't take into account as well is that compounding effect of the savings. So for example, in year 1 we saved $12,000. We would probably then go and reinvest that and buy more shares, earn more interest, earn more dividends, and so each year this will compound and compound and compound, and so as your wealth grows over 5, 10, 15, 20 years, the real tax saving or the real benefit would be far greater than the 120,000. Okay, hopefully that makes sense, and now let's just play with some of the model inputs to see what would happen. Okay, so let's just say that John was actually, he got a promotion and he's now earning $190,000, which brings him right up to the top rate. So every additional dollar he would earn would get taxed at 47%. And this will make the trust even more useful or valuable. And you can see here how savings over the 10-year time horizon have increased even further. Okay? Because we're giving more to Jane in the lower tax brackets as a proportion. Okay, what else might improve it? If we kept compounding our wealth, or if we got a bigger gift and it was actually 2 million instead of 1.5, more dividends every year. You can see there that figure is now approaching $200,000. Okay, now if let's just reset back to the $135,000 situation and the 1.5 million. Let's just say that Jane went out and did some part-time work and she was earning $45,000 worth of wage. Now, in that case, our benefit of using the trust is going to diminish a bit because she's already using up some of her lower income bracket. But there's still a good net benefit there of about $8,000, okay? Now, if John and Jane were both earning a similar amount, you're going to see the benefit drop again because they're both already used up a lot of their lower tax brackets. There is still a bit of a benefit, but after costs, you're saying, all right, $12,000 over the 10-year time horizon. Again, it doesn't factor in the compounding. And it doesn't factor in if you were going to, sell a big chunk of shares in year 6 and you had a massive capital gain. Again, the trust will be very useful in that situation. But you can see we might get to a point where we decide the trust isn't actually worth it. And so let's just say we got a gift of $350,000 instead of 1.5 million. Now we can see, and we're both earning the same wage. We're going to say, all right, total dividends per year or dividend income is about $21,000. And in this case, because we're both in the same tax brackets, we're not actually going to save any tax. And so setting this structure up might not be worthwhile. There are other factors to think about: asset protection, succession planning. Again, if you had a big capital gain, maybe it would come in handy. But as a base case, we might say, all right, it's not worth it at this stage until we get the value of those shares up there. But again, if we're thinking about a long-term strategy, you might start with $300,000 worth of shares or less, but as time goes on and that grows, it will get up there, and then the trust does become worthwhile. If we had $350,000 worth of shares, but Jane wasn't working, then yeah, again, see that it becomes a useful tool because we can basically divert all of that income to Jane here instead of John getting taxed on it. And so in that case, it is worthwhile, probably. So you can have a play around with these figures here and basically work out what our net benefit will be, and whether from a tax perspective at least it makes sense. Okay, as I said, there's always going to be other factors. Another one, again, the legal aspect or the asset protection aspect. I'm going to go through that in another video, but all food for thought. Hopefully that makes sense, and I'll see you in the next one. Thanks, guys.